Hello, everyone, and welcome to the Coinbase Markets Podcast. I am Dave DeWong, the Global Head of Research here at Coinbase. I am joined by Colin Basco, who works with me in research. And we have a crazy show to kind of get through today because obviously the world is kind of going all over the place. Let's start with Iran because this is, of course, the topic that's been on everyone's mind. I feel like if this had been 2 weeks ago, we would be talking about last week's non-farm payrolls, what's going to happen with FOMC next week, for example. And we will kind of get to those topics. But first and foremost, let's talk about Iran. Let's talk about oil. Let's talk about markets because I feel like this is what's been driving things. I feel like over the last 24 hours, like we would have even said something very different about oil prices. And it's not that the expectation isn't there. Like we thought that there would be the knee-jerk reaction to oil prices higher. It's the volatility and the speed of these price moves that has really kind of caught us off guard. And we've seen it cross over 100, come back. Colin, real quick, just kind of take us through those price levels, what you think is happening over here.
Yeah, so I 100% agree. I think what matters most is like how violent that move has been. And I kind of wish that we saw that in Bitcoin. I wish the oil chart was the same as the Bitcoin chart, but clearly not exactly the case. But I think when a market really gaps from like the low 90s to nearly 120 and then snaps back that quickly as well, I think that's a pretty good sign that the risk premium is highly headline sensitive. In other words, it's not like a slow grind that's happening because of, steadily improving demand or some sort of routine supply story. This really is a massive geopolitical tail risk that we're seeing being priced in real time. And you saw a lot of that price action being telegraphed over the weekend in some of these oil perps. So I think just in general, I think a lot of people are really considering this as a potential huge upside tail risk that could be playing out. That being said, we did see oil pull back relatively significantly today. And I don't necessarily think that that's like particularly notable in the sense that we're seeing like a bearish structure in oil being played out. I think we're just seeing a pullback in oil prices just potentially due to some headlines from rhetoric from the president or just general speculation on how long the war will actually last, if there's any chance of de-escalation. That being said, oil has not lost lower time frame structure. So I still do think that the structure from a price perspective alone is still bullish on oil.
Yeah, and the estimates on how long this conflict could last is definitely all over the place. I mean, we've seen that. I think JP Morgan, there's another like third party like macro shop. It's called Oxford Economics, who also put out estimates that these things could be relatively short-lived. Like I think they're putting out estimates of a few weeks, for example, but it's really unclear. And it's also unclear like what would kind of precipitate the end of the conflict. Like, is it just a statement coming from President Trump? Is it something more? Is there full capitulation? Like, I think, this is probably a poly market or a Kalshi kind of question of like, how do you frame a question to kind of even interpret what would like be considered the end of this conflict? I think that the big question, though, is inflation back? Because with energy prices kind of coming higher, I mean, we've talked a lot on the show about the affordability problem in the past. This isn't like a topic that I think is kind of immediate on the crypto side of things in terms of how it's kind of driving price action. But I definitely think it drives how we think about, the Fed's kind of position, what's going to happen in U.S. midterm elections, and how all those things are going to be impacting markets here. And, it was a major thing. Like a week ago, we saw that South Korea, which is, one of the world's largest buyers of oil, I think like 70% of their oil purchases come from the Middle East. Like those guys like had a 20% drop in their equity markets. I mean, like there are some game-changing stuff that's going on in the world right now. I mean, like, Colin, how do you think this is going to start impacting people's concerns around affordability and what this is going to mean on inflation?
Yeah, so I think inflation is the big story here. And I think that's exactly why the duration of the conflict is important. So just very basically put, inflation, higher crude pushes through to the refined products, especially gasoline. So I think gasoline still matters a lot because it hits consumers directly. You may not be tracking crude futures every day, but you're obviously going to notice exactly what's happening at the pump if you're still driving, a gasoline powered vehicle. I kind of lucked out with the Tesla here, so I think Tesla drivers are definitely feeling the benefits now of going to EV. But obviously, a lot of people are not driving EV vehicles. So I think the psychology for inflation also will get priced in relatively quickly, more probably faster than the actual data of the price increases in gas. And I think that nuance is pretty important because just a momentary like idiosyncratic spike in oil prices will not necessarily bleed into core inflation. It will happen though if it's elevated for a long period of time. So I think the duration of that spike in prices is what's important for inflation, which is why the duration of the conflict is more important. So it's essentially the two durations are linked, in my opinion. So if we see the supply disruption becoming more persistent, then I think the story changes more meaningful. And then you can get real questions into like supply flows being questioned in terms of how many ships are able to make it through the Gulf. And if that's just a temporary pain point, then potentially we don't see a huge impact in terms of an energy shock to inflation. But if we do see a sustained conflict, then I do think that there is going to be an impact to inflation. And then we get a huge mess in terms of whether or not the Fed can lower interest rates fast enough to be able to offset the labor market shortages or impact. And in my opinion, the labor market is not looking good at all, just given the productivity gains in AI. So I think that's where it gets into the more of the bear case, but ideally we can resolve the conflict sooner.
Yeah, and we have a Fed meeting coming up on March 17th, March 18th. I mean, for the most part, I don't think anyone's expecting them to do anything because, I mean, even before this conflict erupted, most people thought that the Fed would be on pause. This just makes their job harder, I think, because you have two things kind of working against their mandate at the moment. Because on the one hand, inflation expectations are rising because of where oil prices and energy prices are, and on the other hand, you have jobs numbers that from last week's non-farm payrolls still didn't look great right now. I mean, it's kind of a non-starter because it kind of offset some of the better job numbers that we had the prior month. But still, I think that it's very difficult to know where we really are with labor markets. And we kind of went over the Centrini's article from last week where we talked about concerns around how AI would start to kind of impact these things. But really now the focus is how does the immediate concerns around this, as you said, like conflict and how long it's going to last, really kind of impact things. I think really that's the big question when it comes down to crypto as well. Like if the conflict lasts longer, what does Bitcoin do? If the conflict only lasts 10 days or a few weeks, like how does Bitcoin do? And I don't think it's absolutely clear because I feel like what we're seeing, and we've talked about momentum markets before and where people are trading, but really, I think that what has been happening is people have just been kind of repackaging the Liberation Day playbook from 2025. And that one, I think, caught a lot of people off guard. People didn't have enough risk on during that time. And this time around, I feel like, more people kind of said, well, if I got that wrong, I don't want to be wrong twice. The easy play has been on the energy side of things. Obviously, like it's kind of easy to kind of capture oil prices as a proxy for what's happening in the conflict. But more people are also kind of saying like, let's just reflexively buy this dip because I don't want to be wrong. But quickly this became overbought. And I think bots and AI agents are definitely at work here. So this is also kind of responsible for the massive intraday price swings that we've been seeing. But the question now becomes, well, what if this doesn't just end here? What if instead this becomes a war of attrition? And like this is a theme that I think is starting to kind of pick up on crypto Twitter and other things. But just the idea that, hey, what if this isn't something that we can put down very quickly? What if this becomes like a noose that kind of hangs around our neck? I don't know, like Colin, what have you been seeing on that kind of theme?
Yeah, so I think the prices for oil right now are not necessarily pricing in like a super long war of attrition, but it's still definitely bullish. So I do think that they're at least pricing in a longer than what is expected duration to the war. And I think if we hold this trend here on oil, then that'll be a good sign to suggest that the market is definitely pricing in an extended war and not just an idiosyncratic spike in oil prices and some short and resolution to the war. So I don't know how many weeks that'll be, how many months that they're expecting the war to last. But I think looking at oil prices will be one of the best ways to be able to gauge how the market is thinking about it. And generally, like I mentioned on previous podcasts, I think prices of these key proxies for these large geopolitical events is by far the best way of gauging it, because people will always vote with their dollars, but will say whatever they feel like. So I think the true conviction in terms of how long the war will last is going to be reflected in the prices of oil. So in terms of that perspective, I first thing that I would be looking at is to see whether or not this lower time frame trend is able to hold for oil. Right now it is. So as you can see from the chart, if you're looking at it on the video, it is currently retesting support. So I would expect it to likely hold here. I don't know how high it'll go, but we're obviously seeing a ton of volatility just based off of the rhetoric that's coming out of the administration, as well as the different geopolitical events that are occurring at the Strait. So people are like tracking this from crazy different perspectives also. By the way, I don't know, David, if you've been watching, but there are like people that are, tracking the individual ship movements based off of, I think, like GPS data. Like people have like lots of different ways of evaluating what's happening in real time nowadays. And with AI, like I've seen a lot of people just like coding up using like Claude code, different metrics and ways of tracking it in real time. So it'll be interesting. I think the transmission of data to price is becoming quicker and quicker and quicker. I actually think that headlines are kind of lagging now, just given the fact that a lot of people are going straight to the actual live data and predicting things in real time before headlines catch up.
Yeah, and I know you used to work at an alternative data source, but I feel like, that cat's out of the bag now for those kinds of things. Like I think once upon a time, the idea of, I don't know, checking out like the number of parking spaces occupied in a parking lot was a rather novel concept. It's not anymore, and I feel like that directly plays into what we're seeing right now with how people are trading this stuff. They're just like, oh yeah, there are other ways to evaluate how much is being blocked at the Strait of Hormuz or this or that, and like the amount of shipments are going in and out, and all of that I think is now kind of played in. But let's kind of like bring it back. Like, how is this affecting us in the crypto side of things? And I want to share this chart, and if you're seeing this on the video, I think that this is particularly useful because like I would say once upon a time, like probably in mid Q4, we were talking about how long-term holders, for example, like their positions have been decreasing, but we showed that relative to Bitcoin exchange positions, like i.e. like the amount of Bitcoin that was kind of hitting exchanges. If that goes up, typically that means people are bringing Bitcoin onto exchanges to sell, so it's a negative signal for us. But it didn't really show a great relationship between those two things. So I was kind of playing around with this. And over the last 9 months, maybe a little bit more, what's been interesting is that it actually has been tied much more to breaking inflation expectations. So inflation expectations in the long end actually have been impacting the amount of Bitcoin that's being brought onto exchanges. So actually, it's not the indicator you would think it is. That is, a lot of people are thinking, oh, all right, does that mean it's an inflation hedge? Does that mean that when breaking inflation levels are going up in the long end, that's when people are starting to kind of like be more comfortable about hoarding their Bitcoin? It's actually quite the opposite. It's actually showing that whenever those inflation expectations go up, that's actually when people are more skittish, and you're seeing more of that Bitcoin going onto exchanges to sell. Now, that could be for a myriad of reasons, right? It could be the fact that maybe whenever you see those inflation expectations rise, cross assets, traders are forced to sell positions because their value or risk limits actually are adjusted. So they need to actually sell long duration assets. But still, I think that this has been an interesting pattern that we've seen over the last 9 months or so. I think it bears watching, given the fact that we are seeing energy prices rise and inflation expectations kind of being impacted on the side of things. So far, of course, Bitcoin has been holding up fairly well. I would say that over the last day or two, in fact, like Bitcoin has been gravitating higher. It doesn't seem like, a short squeeze kind of position. It seems like it's more of a sentiment kind of issue. So it feels like for the most part, we don't, we're waiting for confirmation bias right now. But if this war remains kind of like this short term kind of view, then I think that Bitcoin benefits from that. If it doesn't, and this actually lasts longer, then risk assets more generally are going to be hit. I mean, that's kind of the punitive move that we see kind of hitting this kind of stuff. But oil isn't making headlines just on the basis of kind of its price action alone and what's been happening in some of these equity markets. But Hyperliquid has been kind of taking advantage of it. We saw that it's been making a lot of headlines. Oil contracts were live over the weekend. A lot of the price discovery that, kind of happened because this, conflict started over the weekend. People had no recourse to actually trading the futures or other things like on, traditional markets. It feels like all of that has kind of benefited Hyperliquid and crypto kind of more broadly. I feel like these kind of events, these kind of geopolitical developments happening over the weekend, it's kind of perfect for crypto and crypto related instruments. This probably speaks to why the CFTC chairman, like Michael Selig, actually suggested that there's going to be a regulatory path over the next few weeks to kind of bring perps into the U.S. officially. So I feel like this is pretty important stuff right now. I know, Colin, you wrote a lot about Hyperliquid and what you're seeing in terms of, open interest and volumes. I mean, kind of give us the high level thesis about what you are seeing on that side.
Yeah, so we put out a pretty large report last week on Hyperliquid, and it's one of the few altcoins that I think look more interesting to me, just given that a lot of altcoins right now are it's very depressed levels, and I don't think a lot of crypto is trading particularly well after October 10th. So out of the altcoins, I do think Hyperliquid is one of the most interesting ones to look at. And I think just like you mentioned, I think it's really important because there's a couple of advantages that it's been able to capitalize on. Just really quickly for people that don't know what Hyperliquid is, it's essentially a perp dex, but it's been expanding along a lot of different growth vectors that have allowed it to capitalize on just broader different assets that are outside of crypto. And the way that it makes money is that through trading activity, it generates fees, obviously, and those fees then get rerouted to something called the assistance fund. And that fund essentially is systematically buying back hype tokens. So it's essentially a net negative suppressive force on supply, which theoretically should be able to increase price as demand improves with the limited supply. Now, I think the most important and most interesting thing now is they've launched HIP-3 and HIP-4, which are two protocol upgrades that essentially widen the different assets that they allow in different contracts that you can trade on the platform. And that's probably one of the biggest growth verticals in my opinion, because HIP-3, for example, allows them to capitalize on different things like oil, gold, silver, a bunch of different contracts that are not crypto related. So despite the fact that there's been relatively limited interest in trading crypto since October 10th, they've been able to capitalize on the macro geopolitical instability that has been transmitting into these different assets like gold and silver originally, and then now oil, which has been going parabolic. So like whenever we have these large geopolitical events that have been increasingly falling outside of market hours, generally on weekends, the only way to express views on those is essentially through these different perp contracts. And what you're seeing is these very large moves that are happening over the weekend, which are very large opportunities for traders, right? So that makes the product fit remarkably topical right now, which is a huge advantage for Hyperliquid. Now, in terms of like what sets Hyperliquid apart from other sort of protocols, I think from an exchange perspective, the moat and durability are important. So I think a lot of people focus a little too much on headline volume share when they're valuing perp dexes. I still think that's useful, but in my opinion, I would say that open interest is a lot more important. And the reason here is relatively simple. Volume will tell you where people are trading, but open interest is what tells you where they're actually going to keep their risk. So if traders are continuing to warehouse that risk on Hyperliquid, even when the trading volume share gets noisy, then that's still a better signal for Hyperliquid because it signals trust in the venue, execution quality, liquidation mechanics, and general market structure of that DEX when people are willing to warehouse the risk on there and keep open interest on that platform. So from that perspective, I'd say that it looks pretty good. The reason why open interest is a lot better than trading volume as well, from another perspective, is specifically in crypto, you'll see a lot of decentralized exchanges using artificial incentives to try and pop up a volume share, because a lot of people will only look at perp volumes. And so open interest is able to sort of circumnavigate that, right? Because it doesn't just pop based off of people trading more on the platform. So I think from that perspective, Hyperliquid also looks good. The only thing that I would say is sort of on the monetization side. The story gets a little bit more nuanced there, because what we've seen is that the mix of value capture has shifted a little bit. So we've seen take rates actually going up, which means the venue is extracting more fees per unit of volume. But we've seen the buyback conversion ratio go down, which means that less of that fee pool is ultimately making it through to token holders on a net basis. That's important because people generally will collapse those into one story when they're actually two different things. So one is pricing power, which means what the venue is able to charge to traders, which is why you're seeing the take rates go up. The second component is token holder accrual. So how much of that value is actually reaching those hype holders through the buybacks. So the reason why I think we've seen the buyback conversion ratio coming down is because you've seen discounts, staking mechanics, limit order mix increasing, which means that fees on those orders go down. So generally speaking, there's a bunch of different incentives that are potentially decreasing that ratio. But as a whole, that's kind of offset a little bit by the fact that the take rates are still going up and they're able to extract more from the per unit volume of traders on the platform. Unlocks is another question that you see floating around on social media. I think one of the main unlock schedules charts that shows like a huge step up in unlocks in 2026 and 2027. That is actually inaccurate. So the Hyperliquid team has publicly given the numbers of the actual tokens that have been unlocked, and that is way lower than what the token unlock schedule that's been floated on some of these other sites by different data providers is actually inaccurate. So I think from that perspective, the unlocks look a little bit better than what people are saying. That being said, I do think that a lot of these tokens are trading primarily on technicals and momentum right now, just given the fact that Bitcoin is in a bear trend. And I think that generally is the case in crypto, where Bitcoin, whenever it is in a bear trend, I think the probability that different altcoins experience idiosyncratic breakouts, that decreases, which means logically you should be trading it more from a technical or a momentum breakout perspective. So to actually trade this, in my view, what I'm seeing here is that the first resistance band is around $35. And it actually has just rejected that like 5 times already. It rejected it just recently as we're speaking. So my preferred positioning here would be to long the breakout after $35 is reclaimed. Personally, I'm not too interested in shorting this name, just given the fact that the fundamentals are relatively a lot stronger than other projects in crypto right now. So I think there are other altcoins that could be shorted instead.
I think that's a great rundown of both fundamentals and technicals for the Hyperliquid project. And, I think you mentioned about the token unlocks and how that's kind of impacting supply, but there's also the idea that you mentioned HIP 3, HIP 4, for example, from a financial engineering perspective, they're also using that because tokens are being locked up in order to kind of launch those new markets. So it's helping from both the fundamental side in terms of you're launching precious metal markets, you're launching oil markets when the zeitgeist is, most attuned to those kind of topics. But it's also great because it feeds into actually burning, because that means tokens are either locked up or tokens are actually burned in order to kind of account for that. So there is kind of a translation mechanism there. But I think you're rightly kind of pointing out that you need to kind of look at when and how those things are actually balanced in order to kind of get an assessment of what the price actually looks like from a fair valuation perspective. But as you said, right now it's more about momentum more than anything else, and that's kind of how people are trading this stuff. Let's kind of get into Bitcoin as well from the similar approach, because I think last week we were on this call and you mentioned how basically a lot of short gamma, I should say, was kind of sitting there at the 75,000 level. And if anything, I feel like Bitcoin kind of reacted very much in line with what we were predicting in terms of kind of bringing us to that brink, to that 73,000 level. But in order to kind of straight shot it from 75 to 80, we really needed to kind of break through that short gamma level, and we didn't. And we kind of got held back. So we're still inside that, pretty broad 65 to 75,000 range at the moment. We haven't quite broken back into the, post U.S. election, like 75 to 125,000 range, which I know everyone wants us to be in. Kind of walk us through like what you're seeing right now, Colin.
Yeah, I mean, we've even been talking to clients about this, and a lot of people seem confused at the price action. I thought it was pretty reasonable. I think it was pretty in line with what we were talking about. Even last week on the podcast, we mentioned the relative strength in Bitcoin, which would have had you, generally speaking, from a cross-asset perspective, you should have been more positioned for the long side, in which case we got the move to 73K. We called out 73K as a very critical level, just given the fact that there was a lot of positive gamma that was built up there, and the fact that it was a high resistance area from a pivot point liquidity perspective, just based off of the chart that you're showing here as well. And once we got that rejection at 73K, the breakout scenario was invalidated. So after that, we mentioned that there was going to be a high probability that it would drop back to the mid range, which it did over the weekend, right? So 65K, we called out as support, and it ended up rallying off of 65K. So I just think that this really underscores the advantages of trading reactively over proactively. I think the market is dynamic. So I think people should be constantly willing to flip their bias depending on how price is actually moving rather than how they think it should be moving. Whether or not people, will accept it, the world is constantly changing. So the fact that there is a current geopolitical environment that is very volatile, you should, in my opinion, I think you should be agnostic to valuation and be more capable of adjusting and reacting to prices in real time, which will give you the best chance of being profitable. So like in this scenario, waiting for the rejection didn't even give you a bad entry. So like, for example, here and over the weekend and last week, the rejection confirmation at the 73K level on the lower time frame was at 73.3K. So you actually would have gotten in at almost exactly the same level on a short position if you had just waited to see what the reaction would be at that level. And if you were looking for a breakout, it also would have been very quickly invalidated, right? After testing the 73K region, you would have gotten the rejection, and that would have allowed you to be, avoid getting caught offsides in a long breakout. And I think that's why, like, from my perspective, I frame the trading setups as scenarios and how to react to them rather than just saying, long at this level and have your stop loss here. Because realistically, I think the right way to play this is to see how price is reacting at the key level and then trading that reaction. And so from that perspective, the current setup that I'm looking at is if Bitcoin is actually able to hold above 73K, if that happens, then I think the setup starts to look meaningfully more bullish, because then you see the negative gamma around 75K can work in favor of the bullish breakout, and that could send us to 80K, which is where there's another sort of buildup of positive gamma as well as a lot of liquidity and pivot point structure resistance. So I think the key level for me right now is the breakout above 73K. On the downside, I think I'd still be relatively hesitant to short it, but 60K is like the next large area of strong resistance with some level of support at 65 through 67K. But that's kind of been retested several times at this point. So once again, if you were to play it, much better, in my opinion, to trade the reaction rather than just blindly putting limit support like buy orders.
Yeah, and I feel like you can say this at any point in time when markets are concerned, but feels like markets these days are running a lot faster than they had previously. And maybe that's always true, but certainly in an age of AI, it feels like the convexity on that is definitely much sharper than where it was previously. I think that for a very long period of our market history, things were linearly moving faster and like things incremented. And as we got better at trading this stuff and more like sharper at this. But now, I mean, like the example that we just saw in South Korea a week ago, for example, I mean, the risks are a lot more heightened to the extent that I think people are, kind of expecting that if they're trying to kind of capture those macro kind of developments, and don't get me wrong, I'm sure like you kind of still need it. You still need experts out there who are probably good at this stuff and are probably incorporating those views into the market very quickly. But elsewhere, if you don't have that capability, I feel like instead of trying to grasp at straws, you're kind of just saying, well, I'm just going to trust the tape then. I'm just going to trust the price action. And maybe that's why we're in such a momentum kind of based market right now, alongside the fact that AI developments have moved so quickly that anyone can kind of spin up a model these days. But with that, that's a wrap for us this week. I don't want to kind of extend it any further. Again, please follow us on Twitter. It's Dave DeWong and Colin_Basco. Let us know if you appreciate this by liking and subscribing. And otherwise, you can reach out to us if there's any topics we aren't covering. Thanks a lot, everyone.
All statements and analysis correspond to the date of this recording. This recording is only intended for sophisticated investors. This recording should not be copied, distributed, published, or reproduced in whole or in part. Neither Coinbase nor any of its affiliates make any representation or warranty as to the accuracy or completeness of the statements or any of the information contained in this recording. The views expressed in this recording are not necessarily those of Coinbase. Coinbase is not providing any financial, legal, accounting, or tax advice or recommendations. The receipt of this recording by any listener is not to be taken as a giving of investment advice by Coinbase to that listener. The information in this recording is believed to be current as of the date of this recording and will not be updated or otherwise revised to reflect information that subsequently became available or a change in circumstances after the date of this recording. Investing in cryptocurrency comes with risk. Prior results are not guaranteed, and prior results do not guarantee future performance. The listener should consult their advisors before making any investment decision. Coinbase may have financial interests in or relationships with some of the assets, entities, and/or publications discussed or otherwise referenced in the recording. Any references to third parties, investment strategies, or digital assets do not imply Coinbase endorsement or approval of any third-party investment strategies or digital assets or any website or content related thereto.